Well, greetings. On behalf of your financial team, my name is Paul Ried, and we want to welcome you to our first live video town hall meeting. First of all, thank you very much for attending. We've got, boy, about 187 of you attending. So thank you so much for taking advantage of the opportunity. It's our pleasure in presenting this. You know, I'm struck by the fact that we've all been through this tremendous crisis. We've got business shutdowns. We've got stay-at-home orders. And frankly, I've talked to a number of you, and I know Tim has as well, that this crisis has touched your family. Sad to say, some of you have healthcare workers, some of you have grocery workers that are your kids. It's all touched us. And I want you to know, amidst all this uncertainty, folks, we are here for you every step of the way. And part of that is through the communication that we're providing. Hopefully, I know many of you have seen the communication we provided through videos and through market letters and through blog posts. That's going to continue. Found that those that registered for this live, actually about 91% of you have seen those, so we're thrilled. And about 50%, a little over that, have seen all the videos in our series. This is really kind of the fourth video in our series. So again, thanks so much for taking advantage of this opportunity. We're looking at how we can best reach out to you, both one-on-one through our meetings, through outbound calls from our office, and also in a format like this. So thanks so much. And you know, a lot of you have asked how we're doing. Thank you very much. I want to tell you, we and your financial team are doing well. We're working remotely. There's 4 of us that are in the office. We're taking all the precautions necessary. Right now, we're broadcasting, by the way, from each of our separate offices. We're more than 6 feet away. And we've been taking all the precautions. We have most of your team, 8 of them, working remotely. And again, we're here to serve you. We're right on board, and we're thankful for your trust and confidence. Well, a little bit about the process we're going to go through. First of all, for you that are watching via Zoom, and we thank you for the questions that you've submitted. We've categorized those, and we'll be taking those questions, and we'll go about 30 to 40 minutes or so. And some of you are joining us by phone. This is live. The questions were submitted in advance. And folks, we're going to give you an opportunity for follow-up as well. So we want to see how this is going for you. It's our hope, our goal, to really provide information to you in the way you can receive it, so that really helps you in your planning, because that's what you've trusted us to do over the years, and we're honored and privileged to continue to do that. Well, a little bit about the statistics that you all submitted when you registered. First of all, again, we've got over 185 people attending, which is wonderful. As I said, about 91% of you have read at least some of our communication. And one of the questions that we had was really about your level of concern. You might recall, folks, it was 1 to 5. 1 was actually not really concerned much at all about this. 5 was kind of concerned, anxious, and worried. We also had a 0, which means you're looking for opportunity and you want to reinvest more. So just for your information, the average score was a 2.33. So we've been very pleased that as we've reached out to all of you, you've expressed confidence in the process that we have and the plan we have in place. So thank you so much, and that gives you a little bit of insight into what we've discovered. Well, we're going to begin, and I'm first going to have in our queue. You're looking at Tim Kimmel, naturally, who's our Chief Financial Advisor, CFP. You've got Adam Jordan, who's our Chief Compliance Officer and Director of Investments. So what we're going to do is have them speak a little bit, just a few minutes, about a couple of topics. Then we're going to go right into the questions. So first of all, Tim, I'm going to ask you to speak a bit more about maybe our firm's response in this process, a bit more of a big picture about what's going on. And then Adam, I'm going to ask you to speak about a little bit more about maybe the markets during this time, and some observations you might have that might be beneficial to our clients. So Tim, please go ahead.
Yeah, thank you, Paul, and thank you everybody for tuning in. It's a great honor to help people through this process, and it is a process. It's one of those things where many would say it's unprecedented, right? We're in uncharted territory, but one thing that we know for sure with our 35 years of doing this and helping folks through this process is that the events, folks, are always unique. Never been through an event like this, never been through 9/11, Y2K, other significant events, 2008, 9 even. But one thing that is consistent through all these events is it's still driven by emotion, right? There's still a tremendous amount of emotion behind this event. And obviously everybody knows that emotion is fear, right? First, fear about health and getting through this healthy, right? Or as healthy as we can possibly be. That's preeminent, that's the primary focus. But then, as we know, there's also a financial health piece to this as well. And we're working very hard at our office here and remotely, right, to make sure that we come out of this as healthy as possible financially as well as physically. But with that said, the emotion of fear is a powerful one. And the reality of fear is that that is a consistent theme throughout all these events that we've experienced over 35 years now working with folks. And so the events are unique. The emotion is the same. And yet it's easy to get into this cycle of fear and anxiety. And I understand that there's a lot of uncertainty and this is very fluid. But the point too is that what fear does oftentimes is allows us to focus on things that are maybe in the next week, 2, 3, maybe even 3 or 4 months out. But the reality that we're seeing is that our plan, as you know, we've talked to many of you over the years, is our plan is not a 3, 5, 8 month plan. It's a 3, 5, 8 year plan. And with that said, we believe, and again, just our opinion, not that you have to share it, but we believe there'll be elements of this that are going to linger on for many years to come, things that won't come back, things that will change dramatically. I think this is a 9/11 type event where how we live life before and how we live life after are going to be different. And there'll be other things, right, opportunistically that develop out of this. And one thing that I'm very confident in, I know Adam and Paul share this feeling, is that the United States economy is very resilient. The average consumer, very resilient. And we certainly know corporate America is very opportunistic and very resilient, and we'll get through this as well. But it's going to take time, right? This isn't going to be over quickly. We believe that, after this initial 34% drop that we saw from peak, that we could retest those lows. I'm certainly not hoping for that. I know Paul and Adam aren't either, but that is very possible. And the reality there is that oftentimes when we have these type of events, the market prices in these expectations of some bad stuff. And the question ultimately, which will be answered with time, is has the market priced in enough of that negativity where we've actually seen the bottom, right? And if it has, then the markets will trend flat or even trend higher from this point. But if the market hasn't, if there's more bad news to come, then guess what? The markets will retest those lows, maybe even go below those lows. So that's something that we have to be conscientious of. And so again, the emotion, right, that we're dealing with is fear. Fear causes us to do things that oftentimes seem to make sense in the moment and in the heat of the emotion. But oftentimes when it comes to financially, it's counterproductive to our longer term investment strategy. With that said, though, a lot of people have asked, well, what are we doing as a firm in response to this event, right? And this disruption, right, that this crisis has created, not only, again, societally, but also with regards to our investment goals and strategies. And the bottom line is that there's really several things that we're doing. One is that we're focusing obviously on your particular goals and objectives. Now, each one of you have a unique set of goals and objectives. And the idea here is that we've worked with you right over the years, we've met, we've talked, and we believe we fully understand what those objectives are. Now, if we're honest with ourselves, right, those objectives really haven't shifted tremendously. The reality, what's changed is how we emotionally are processing this, right? Just simply 3 months ago, people were very optimistic and hopeful. Today, obviously that's shifted, but that's not a shift in your objectives, that's a shift in your emotion. So we're evaluating and continuing to stay on top of each one of your objectives and goals as we move ahead. And again, I remind you that I believe most of your objectives, right, are 3, 5 year objectives, if not longer. The second thing we're doing is not only focusing on your goals and objectives, but also we're working very hard in making sure that the portfolio design that we've set for each one of you is functioning, right, the way we would expect. Now, not always the way we'd like, I get it, but the way we would expect. And each time we talk about diversification and the benefits of that in our meeting, the reality of it is that diversification doesn't eliminate risk, right? It simply softens the risk. And if you think about what's happened, the markets are down 34% as of the lows, right? I think we're down 17, 18% as of today. So we've seen a nice little comeback here, which is encouraging. But the point of the matter is that your portfolios generally are not down anywhere near that degree. So again, the portfolio is functioning, right? We're making sure that that is working the way we expect at this time. Third thing that we're doing is making sure that we communicate. As Paul mentioned, there's been a tremendous amount of communication that we've really worked very hard at, from videos to market blogs to commentaries to even some calls that we've been making proactively. And so our dedication to you is certainly to keep you informed. Not that that information is going to necessarily change your viewpoint, but hopefully it provides some perspective, right? That allows you to kind of process this a little bit more appropriately or effectively, again, with those goals and objectives in mind. And then the other things that we're doing, fourth thing that we're doing, generally speaking, is making sure that, you know, the fund managers on a granular level are upgrading their positions, right? Not because they're positioning for the next, again, 3 to 5 months. They fully are aware that the positions that they're taking could continue to go down, but they're upgrading to companies that they absolutely love. Why? Because they're believing that, hey, long-term, 3 to 5 years out, that's how they're posturing portfolios. Adam will go into a little bit more detail on that as we get further into our discussion. But that, in essence, is really being productive, controlling what we can control and not necessarily focusing on the anxiety or worry, because that stuff, unfortunately, we can worry about, but that's not going to add any value to your life or time to your days. So we're focusing on the portfolio, each individual holding and position that we have, but on a granular level, making sure those managers that we're talking with generally now on a weekly basis are doing what we would expect that they should do, which is upgrade their portfolio for the quickest and most successful recovery in your plan. And then the fifth thing that we're doing is on a broader scale, right? Adam and his team and Paul and I certainly are part of that, are upgrading our positions, right? You've seen a few changes within allocations in the last 2-3 months even. There might be more to come that we're evaluating and deciding, but that in essence is our process, right? From on a broader scale, evaluating positions and upgrading those positions too, to the best we possibly can to get through this and to see recovery in full. So again, what we're focusing on is not necessarily things that we can't control, and that's certainly the virus and how quickly this, or how long this might go. Those are, again, very fluid questions that nobody has true answers to. We're not focusing on the election coming up this fall. That obviously we can't control that outside of a few votes. We're focusing on things that we can do productively to really further your agenda and your objectives, right? Which again is the way that we view is the right response in this environment. So I'll turn it back to you, Paul.
Great, and thanks, Tim. And you and your team have been talking to the money managers. You've been keeping abreast of the economy, with the idea of, are there changes we should reflect in the portfolio? What are the managers doing? So maybe, Adam, you could speak a little bit more towards the market and the economy, and maybe talk a bit about the portfolios as well, if you'd like.
Yeah, definitely. As Tim was mentioning, it's been a wild month and a half that we've had. Markets peaked February 19th, and again, as I mentioned in one of the blog posts, it was the fastest 30% correction in history, and at 22 days. So it's definitely been a wild ride. It's included 2 of the top 10 biggest single day market drops, as well as 2 of the largest single day market advances. So we've definitely seen a wild ride. And again, among those top 10 days, there's actually only 2 other time periods that those big drops and advances took place, and that was during 2008, which I'm sure many of you experienced as well as we went through, and also in the 1930s. Those are the only periods that had these sorts of wild moves. So again, what we're looking at here is essentially markets, as Tim was saying, markets essentially overreact and underreact, just like we in our emotions overreact and underreact. And what we saw going into that drop was markets essentially pricing in, and maybe they haven't yet overreacted, but they reacted quickly. What they did do is price in a market fall of 34%. And so that's actually right in line with what you would experience in an average recession. So there's actually nothing as far as market pricing wise that says, they basically say this is a recession. I think we all know from the recent news, we're pretty much in a recession right now. They're not going to announce that for quite some time because it's always in retrospect, but we started back in January, we had about 6 million people unemployed. And just in the last 3 weeks, we've had 16 million people added to the unemployment rolls. So if you're to think about, we almost had about a 4% unemployment rate. We're well above 10% now. We're probably closer to 14 or about 14 to 15%. So unemployment rate has spiked dramatically. And again, what was published last time, just a week or so ago, the unemployment rate, that wasn't the real unemployment rate because that was out of date data. Essentially, that unemployment rate that you saw was from the week of March 12th. And that's just, you remember, that's just right around when, in our area at least, the lockdowns were going into effect. A lot of the other country hadn't even started their lockdowns yet. So none of those unemployment claims were reflected in that unemployment rate. So next month, when we see, and again, we're going to continue to see more large unemployment people add to the rolls. And so it definitely will be a dramatic number when it comes out. But again, markets are expecting that large number. And again, what we've actually seen as far as unemployment claims, we've seen as many in the last 3 weeks as we did during the whole 2008 recession. So it's all been condensed. The unemployment offices are working overtime to get benefits to people, and they're getting the systems worked up. The federal government's giving the states some extra resources so they can boost that up. So it's definitely going to be some challenging times here in the short term, as definitely the CARES Act did a good step of giving additional benefits above and beyond. They're getting the extra $600 a week on top of the regular state unemployment benefits. So that's going to be a good boost. But again, there's this time period that people aren't seeing any of that money. And so they're really, everyone has a stay-at-home orders, but they're really having to hunker down on those statements. Again, it's going to be a lot going on, and we see every day the Federal Reserve doing new measures. We just saw today. Now they stepped in to buy high-yield bonds, or what is often considered junk bonds. That's bonds of companies that are very indebted, and that's an extreme measure. Generally, the Fed is only known to buy government debt or maybe mortgage-backed securities like we saw in 2008. So we're seeing all these measures, and just as our stay-at-home orders and social distancing is meant to flatten the curve, I think what the Federal Reserve is doing is essentially trying to flatten that down. The markets were reacting, bonds were selling off, high-yield bonds, even investment-grade bonds were selling off dramatically. In fact, during the 19-day period just last month, investment-grade bonds, so not even the most indebted issuers, investment-grade bonds sold off just as much, about 20% over a 19-day period, which was equivalent to the sell-off during the Lehman crisis in September, which is also a 19-day period. So again, it's markets have reacted extremely, but as Tim mentioned, there could be further downside. Markets, again, just like people, have extreme emotions. Over a month, went down 34%, and here we've rallied back 25% off of the lows around March 20th. But again, the way the math works is you need a lot more gain to make up for losses. So we're still down 17, 18% off of the peak, because it takes technically to get back from about a 34% loss, you need a 50% gain on the upside. So again, if we look at past history, normal recessions is 37%. And think about some of the things that caused some of the more extreme recessions. We had a 48% drawdown during the oil embargo in '73. We had a 49% correction during the tech crisis in 2000, and we actually had a 57% during the last 2008 financial crisis. And if you're looking at what's gone on here, I think the world's on stay-at-home orders. We've never seen this, so you could easily say it is more extreme situation than has happened in those past instances. I mean, the market's digesting a lot of information. You could almost say that if you just had one aspect of this that's gone on, we could, right now we're only 18% off of the peak if you look at S&P 500, but we've had drawdowns of 19, 20% just off of, in the end of 2018, we saw, just because the Federal Reserve, people thought the Federal Reserve was raising rates too much, and we wondered about that China spat. That seems so small in retrospect. So again, a lot of uncertainty, but the Federal Reserve is again trying to flatten the curve on the financial side by buying up assets, whether it's treasuries, high yield bonds, and people say, is the Fed out of ammo? And if you look at Japan, we could say no, they're not, because at some point they could even go more extreme, although people can debate whether it's legal and our Congress allows it, but Japan has done it, and they could buy equities outright. So they possibly have more ammo, but again, we'd probably expect markets to be down further before they took those sorts of drastic measures. So what are we doing in these scenarios? Well, as we mentioned in the past, while you never know the reason for large sell-offs in the market, they're going to happen. So we built the portfolios understanding that we don't know if it's going to be a pandemic. We don't know if it's going to be trade wars or debt crises. We don't know what the cause of large drawdowns are going to be. We just know that they are going to happen. And if you look at, in fact, in any 10-year period of an investor, on average, you have just a slightly over 50% chance of experiencing a 30% drawdown. We didn't have one last 10 years, and now we enter this decade, and we quickly get a 30% drawdown. And that's also why we don't want to time the markets. We want to make the portfolios for your objectives, your time horizons, your income needs, making sure we have funds in safe assets so that when you need to draw income, we can take it from there and not things that have sold off extremely. Again, if you're always just trying to say, oh, is the trade war is going away, maybe we should get more aggressive, when you're looking at all these short time horizon aspects rather than your goals and objectives, that's when you can expose yourself to taking on more risk when these unexpected events happen. So again, what we're doing now is essentially, we always have, and a lot of people may be saying, well, we've seen a little bit more activity in the portfolios recently, but in a way, it's just a readjustment of what's always going on inside your portfolios. We inside each fund, we have very flexible mandates. We give managers a lot of flexibility in what they can buy and sell. And so behind the scenes, when you're not seeing confirmations, things are going on behind there. They're maybe selling some companies based in the U.S., buying some based internationally, looking for value. This is all going on behind the scenes. You can pull up the holdings on these funds, and you would notice that from quarter to quarter that they're changing. But when you're looking at your statement, that's you're never gonna see that. Now, what we've done in some instances, though, we also have some funds that don't quite have as much flexibility in your portfolio. we have those because we know that we kind of want this dedicated area. We think maybe there is value in this, keeping them constrained to this area of their expertise. But as the Fed's gone down to zero rates, just like the rest of the world, for instance, we did like some short-term U.S. bonds. But now that the U.S. has gone down to zero rates as well on the short end, now the U.S. isn't that much more attractive than anywhere else in the world. So we want to look around, give managers the ability to go around the world on other, high-grade countries. So we're talking about Australia, Norway, Canada, all these other, Japan, other G10 sort of high-grade countries, and give the managers flexibility to look at each of those individual countries' debt dynamics, their interest rate policies, and currency situations, and take advantage of opportunities as they see fit. So it's all about giving our managers a little bit more flexibility in this time, especially when things are moving so fast. We want to give it to the experts in each area, whether it's international, whether they're experts in international, whether their focus is US-based companies. We want to give it to each of these managers according to their expertise and let them make these more day-to-day moves while we make the moves for the longer term based on your objectives. So back to you, Paul.
Yeah, thanks, Adam. And I appreciate that, because what you did, Adam, as well, is talk to a number of questions that were out there too. Roger asked a question about, other than fund diversification, what, if any, new investment strategies are you recommending? We also had questions on how are you being proactive during the midst of this. So great. Tim, I want to turn it back to you. Some of the questions centered around the CARES Act and RMD. And part of what we did is put out, of course, that summary of the CARES Act. And we were allowed to suspend the RMD requirements. And one of the questions, this is from Jay, is there any scenario that you would take the RMD even though it was suspended? And then what's the impact of that? And there's just a question about the logistics. Is it taxable? Do you make it up in the following year? A couple questions on that. So Tim, and are the rules changed for 2021? So Tim, why don't you take a few minutes and talk to that, please?
Yeah, no, as Adam said, the government's taken some extraordinary measures to kind of flatten the curve, as he said very appropriately, on the financial side of it. And one of the things that recently passed, as a lot of you know, is this CARES Act. And the CARES Act is $2.2 trillion stimulus package, a pretty significant bipartisan response to the economic impact here. By no means do we think this is the last of the stimulus packages. I think there's others to come, just for the record. But to speak to the questions on the RMD, Paul, that definitely this year's required distribution requirements, so basically suspended. So what that means in essence is there is no required distribution this year. That we expect to pick up next year, 2021, in its normal routine. There is no double hit next year if you don't take it this year. Basically, just like we saw, I think it was in 2008 or 9, the government suspended these required withdrawals before, and that simply is designed to help folks that are in that 70 or 72 range now to soften again the impact of this, so they don't have this mandatory distribution if they don't need it. Now, one of the questions was, hey, would there be any scenario where we should take it, right, where it's not necessary? And that would be, in my opinion, more so based upon, well, if you need the income, then by all means, continue on with the distribution. But if you don't need the income, then it probably would make sense to defer or basically not take income this year, because you don't want to be selling those shares when valuations are low. The best chances you have, right, proactively to help your portfolio recover is to not take those distributions or reduce those distribution income benefits if you can. But if you can't, you need that income to supplement your cash flow, then by all means, continue on with that. So yeah, the CARES Act, one of the stipulations within it, no required distribution for 2020.
And then, and Adam, a couple questions, and this came from Jeff. What are the various fund managers doing? What approach are they taking? And I think I answered this too. Is your office able to fully operate during the stay-at-home, stay-safe restrictions? And naturally, folks, we have a business continuity plan that's been implemented and we're able to fully operate and fully function. Thinking about that question, Adam, about what are the managers doing, is there anything else you want to add to what you said about what the managers are doing in the midst of this, or how proactivity is defined as we see it?
No, essentially kind of what I was saying before, managers are kind of making those day-to-day moves. We set the strategic asset allocation plan and assign each manager kind of their duty, their role of that, whether it's kind of acting as a ballast to the portfolio, whether it's seeking out growth opportunities, whether it's giving them full range. And some people give them full range if that's kind of their expertise to kind of move between the U.S. or international. So it's really about giving the right managers flexibility, and managers that have more niche expertise, keeping them kind of more constrained in that area that we want kind of long-term exposure to. But again, we're looking at these things all the time, and measures by the Fed are going to have different effects. So they're pumping in way more money than they did in 2008, both fiscally on the fiscal side and on the monetary Federal Reserve policy. So these are way more extreme. In 2008, we didn't get inflation from much of that. Inflation stayed low. Whether that will be the case this time is to be determined. A lot of the money kind of stayed in the financial system. It was all directed at corporations. If we see a broader range of measures that get the money into people's hands a little bit more, while that could help consumer spending and help us come out of this quicker than otherwise, that could also have some inflationary effects that we'll want to keep an eye on. So again, we're looking at the strategic plan, seeing if any small adjustments might be needed, but we're leaving the day-to-day moves to the money managers.
And Tim, to you, a question came up, available cash. We always hear that you buy low and sell high, and our emotions kick into this, and naturally, in hindsight, we look back in 2008, 2009, we think, gee, we could have bought, a certain stock, or we could have done this or done that. And the reason why folks don't do it is because obviously emotions run high, and it's kind of fear and uncertainty. But what would you say about someone that says, I've got available cash right now. I'm thinking about either repositioning it into, maybe it's going from a bit of foundation to growth, or maybe it's putting more cash to work. What would you say to someone that asked that question?
Yeah, I'd say, good question. I'd say, first of all, if you have the right time horizon, right, obviously everything's predicated off of that. If you've got a 3 to 5 year time horizon, and you've got some available cash, then this is an opportunity, right? We've been through scary events before, as I alluded to, 2008 and 9, very unprecedented in its own right. And yet I didn't know anybody that bought late in 2008, even though they maybe didn't get the exact bottom, that was disappointed with those purchases. Even though, again, the market continued to go down into early 2009, if they had the proper time horizon, they didn't get the absolute lows, but they were very pleased for a 5 to 10 year period of time with those purchases. So if you've got the right time horizon, Paul, if you've got the stomach, right, because as Adam alluded to, and I mentioned earlier, that this could continue on. This is a process. This is going to have ebb and flow to it. Market volatility, we think, is going to continue to be quite extreme. The old saying is, it's not timing the market, it's time in the market. And ironically, are the only thing that people don't want to buy discounted. It seems like everybody wants to buy at the highest price because that's when it feels good to do it. But when is the right time to purchase? It's when you've got that pit in your stomach. You don't have that comfort level, right? Warren Buffett said it best. He said, "Be greedy when everybody's fearful. Fearful when everybody's getting greedy." And that's why we don't chase returns. That's why we stick to a disciplined asset allocation plan, as Adam alluded to. But on top of that, right, is that if you've got some cash available and you've got the proper time horizon, and you feel like, hey, you don't need those dollars for any particular reason up front, then now might be an opportunity over the next 2, 3, 4 months to take advantage of that. And there's different ways to do that. I would encourage you to call your situation, talk to one of the advisors on the team. And, you know, that could mean, hey, we put money in all at once. So we could mean we dollar cost average over a period of time. So one of those things that you can talk about strategically, right, with your particular situation, with each you know, individual advisor that you might contact. There's a number of ways, right, we can go about this. So yes, I answer the question. I think there is opportunity. Again, recognize strong stomach, and it certainly takes a time horizon. But if those two things fit your criteria or your situation, then yeah, it could be very well an opportunity for the long term.
Perfect. And Adam, we're going to wrap up this last question, then I'll summarize. And I'm going to give you this question that we get routinely, and I appreciate the client who wrote this. They said, you know, hey, I appreciate all you're doing. I know you don't have a crystal ball, but you know what I'm going to ask. When is this going to end? You know, how long is this going to be? So let's wrap up with that question, and then what I'm going to do then is just summarize everything. So Adam, just at a, not length, just give us your thoughts on when that question comes to you. I mean, what do you say to someone?
Yeah, it's no crystal ball for sure. But I would say it's going to take some time. It's going to take, this is not, you know, the markets have been very V-shaped right now. But my personal opinion is that markets may be thinking that things are going to return to normal sooner than might be possible. I mean, this is, the whole world essentially is on shutdown. This is not something, and it's a you know, pandemic that no one's really experienced, and especially with the measures that have been taken. And so that's also going to leave a psychological effect on people. If all of a sudden everyone opens tomorrow with knowing that the cure isn't out, a vaccine's not out, not knowing who's contracted it, who hasn't been exposed to it, people are not just going to go back to the bars or in the movie theaters. People are not just going to go back about their normal day. This is it's a psychological imprint been made on people. So this will be, everything just not going to go back to normal right away. So definitely, again, expect things to be elongated. You know, we can be happy if it happens otherwise and we're all back to normal, but I don't see the reason for that expectation. So that'd be what I would say is it's going to take some time.
Well, folks, you know, hey, it's our pleasure in conducting this, and what you heard, you know, you heard first of all a bit more about what we're doing behind the scenes. I think that's important to know that hey, we're here for you. We're honored to serve you, and a lot goes on behind the scenes. And now from our Bellevue offices, we're working as well as remotely. You've heard a bit more about the markets and the economy. You might remember the video that we talked about, a U versus a V versus a lopsided L. Well, it might be shaped like a W. So just remember, your portfolio is built to last and built for the long term, different cycles. Heard a bit more about the CARES Act. And what I would encourage you to do, if any specific questions about your situation, please don't hesitate to reach out to us, reach out to your team. And that would be either by email or by phone. We're here for you. The three of us and the other folks on the team, that's what drives us, is frankly your success and your security. So folks, now this is being recorded, but is now Good Friday's tomorrow. Easter Sunday is coming up. We want to wish you all the best. Happy Easter. Thanks so much for attending. And we really appreciate your loyalty, your confidence, and your trust in us now and in the years gone by. Thanks so much, folks. Take care and God bless.